A Renewable Energy Certificate, or REC, is a market-based instrument. When a producer generates 1 megawatt-hour of electricity from a renewable source and feeds it into the grid, they receive a REC. It acts as verifiable proof of green energy production, allowing energy to be legally traded, counted, and claimed. This chart shows the sheer financial velocity of this mechanism. The global REC market is scaling aggressively, valued at nearly $28 billion in 2025, and projected to reach over $45 billion by 2030. But the infrastructure handling those billions is aging. Right now, most institutions manage these certificates using traditional legacy ledger systems. These systems rely heavily on manual verification and paper-based tracking. That creates massive operational bottlenecks, long settlement times, and a highly vulnerable surface area for data manipulation and fraud. We cannot scale a global green energy economy on accounting infrastructure that remains slow, centralized, and open to falsification. To fix this, the market requires an automated, transparent system. Blockchain technology offers a distributed, immutable architecture perfectly matched for the issuing, trading, and verifying of these certificates. The contrast is stark. You replace manual backlog and high fraud risk with cryptographic immutability and instant automated execution through decentralized tokenization. But for CTOs and developers in the energy sector, adopting blockchain creates an immediate architectural dilemma. You have to commit to a specific Layer 1 network, and right now, that choice comes down to the two dominant platforms, Ethereum and Solana. Make the wrong choice here, and your product breaks. Pick a chain that doesn't fit your business model, and you will either bleed out from crippling transaction costs or fail strict enterprise compliance audits before you even launch. We aren't here to crown one network as the absolute winner. We are going to look at recent empirical benchmarking data to map the correct blockchain architecture directly to your specific market requirements. Let's look at Solana first. Its primary technological differentiators are a stateless design and a proof-of-history consensus mechanism, which allows nodes to track time independently. This diagram shows the physical transaction flow on Solana. Because of that independent timekeeping, a transaction can be processed sequentially by the deployed Rust program and the client interface, without needing to wait for network-wide validator updates. Researchers tested this by building SolRecify. This architecture highlights the Anchor framework and RPC components, streamlining secure deployment. The outcome is extreme efficiency, achieving incredibly fast processing while keeping fees down to fractions of a cent. Solana solves the speed and cost bottlenecks entirely, but the trade-off is that you are building your enterprise on a newer, less regulatory-tested ecosystem. On the other side is Ethereum. It relies on a highly mature, battle-tested proof-of-stake network and executes logic through the Ethereum virtual machine. This chart outlines the standard Ethereum transaction flow. It shows how the EVM bytecode deployment and the Web3 client strictly manage interactions with the broader network nodes. To test Ethereum, researchers deployed CertF, utilizing established developer tools. The diagram highlights the Alchemy provider, a critical bridge routing data into the network. This loop guarantees maximum decentralization and absolute data integrity. But that trust acts as a tax on the system. To get Ethereum's institutional security, you absorb slower finality times and higher gas fees that heavily compress your profit margins. To see exactly how these architectures perform under pressure, researchers benchmarked SolRecify against CertF across 3 core market actions: REC issuance, the sale of a REC, and the submission of a REC request. These performance profile charts show the transaction fee disparities. Solana sits completely at the top of these curves, achieving the lowest possible transaction costs in 84 to 96% of the simulated workloads. And this file-in plot graphic illustrates the duration data. You can see a massive, dense cluster, indicating that Solana delivered a median relative time savings of up to 85% over Ethereum. The empirical testing is definitive. On pure speed and cost, Solana wins. That means your architectural decision doesn't hinge on finding the fastest code. It hinges entirely on how much your specific business model values Ethereum's established institutional trust. Let's apply this data. First, imagine a dynamic peer-to-peer digital marketplace where users and smaller producers are trading green energy certificates continuously. In this scenario, developers are building high-frequency trading platforms or retail applications that process hundreds of microtransactions a minute. When mapped to our decision matrix, this lands squarely in the high-volume, lower strict compliance quadrant. This targets Solana. Dynamic models physically require near-zero fees and instant finality. If it costs $2 to trade a $3 certificate, the marketplace collapses. For high-volume trading, operating in a newer ecosystem is a mandatory trade-off. You must secure that throughput for the market to be viable. Now look at the complete opposite end of the spectrum: massive, national-level energy infrastructure and highly regulated utility companies. Here, architects build enterprise compliance tools and national registries. In this environment, flawless regulatory audits and absolute data security are the only metrics that matter. Plotting this profile on the matrix places it firmly in the high-compliance institutional quadrant. This is Ethereum's domain. National institutions require battle-tested smart contracts and deep ecosystem maturity. They need a network that auditors and compliance officers already know and trust. In this environment, enduring higher gas fees and slower processing speeds is simply the acceptable price of trust required to onboard institutional players. Chasing pure technological speed without first mapping out your long-term market design is a guaranteed way to build the wrong product. This radar chart compares the platforms visually. It shows us that Ethereum and Solana are not strictly competitors. They are highly specialized tools that deliberately offset each other across scalability, security, and speed. Your infrastructure shouldn't be an arbitrary choice. Define your required business inputs first, know exactly who is trading and how fast they need to do it, and the correct underlying blockchain will automatically select itself.